Hi, welcome back. In this lecture, we will go through part 1 of the profitability ratios, where we will walk through the gross margin ratio. On this slide, we will calculate the gross margin ratio for Amazon. So, what is the gross margin ratio and why is it important? Well, the gross margin ratio is a company's net sales less its cost of goods sold or cost of sales. It is the sales revenue a company retains after incurring the direct costs related to producing the goods it sells and the services it provides. In simple terms, the higher the gross margin, the more capital a company retains on each dollar of sales. So let's calculate this for Amazon. First, we'll need to calculate gross profit. So how do you get to gross profit? Well, you take net sales less the cost of goods sold or cost of sales. Here, we can see Amazon had net sales of around $280.5 billion for fiscal 2019. It also had cost of sales of around $165.5 billion. Taking the difference between these two, we come up with a gross profit amount of $114.9 billion, or a little under $115 billion of gross profit. Now, when you take the gross profit amount of around $115 billion over $280.5 billion of net sales, we come up to a gross margin ratio of around 40.99%, or around 41%. So what does this mean? Well, this tells us that Amazon makes around a 41% gross profit from every dollar of sales. In other words, after taking its revenues and backing out the direct cost of sales, Amazon retains around $41 of profit for every $100 of sales. Now let's move on to Walmart and see how their gross margin looks. We'll use the same formula, which is we'll calculate the gross profit for the company and divide that by its net sales. For Walmart, we see net sales for the year was $523.9 billion, or a little bit under $524 billion. Now, the cost of sales relating to that is $394.6 billion. Now, when you take net sales less the cost of sales amount for the year, we calculate a gross profit of around $129.4 billion. Now, when you take that gross profit amount and you divide that over net sales of $523.9 billion, we come up with a gross margin ratio of around 24.69%. So now, what is this telling us and how does it compare to Amazon? Well, this tells us that Walmart makes around a 25% gross profit for every dollar of sales. As compared to Amazon, we can see that Walmart has a lower gross margin. Amazon's gross margin is around 41%, which is much higher. In other words, after taking its revenues and backing out the direct cost of sales, Amazon is able to retain a higher margin from its own sales. One key item I want to highlight here is that Amazon's gross margin ratio is actually quite good for the retail industry. And although Walmart's ratio is also very good at around 25%, Amazon's margin is just so much more dominant because it's able to generate a higher gross margin on its products. One thing I'll note, and we'll see this in later lectures is that this is largely due to the makeup of Amazon's goods and services. Welcome back. In this lecture, we will now go through part 2 of the profitability ratios, where we will walk through the operating margin and pre-tax profit margin ratios. On this slide, we will calculate the operating margin ratio for Amazon. So, what is the operating margin and why is it important? The operating margin measures how much profit a company makes on a dollar of sale, after paying for variable costs of production, such as wages, raw materials, but before paying for its interest and taxes. This ratio is also commonly known as the return on sales. In other words, this shows us the proportion of revenues that are available to cover non-operating costs such as interest expenses. The key point here is that a good ratio is a good ratio to compare the margins across different companies in the same industry. And the higher the ratio, the better it is. So how is this calculated? Well, this ratio is simply calculated by dividing the company's operating income over its net sales. So let's calculate this for Amazon. First, we'll locate its operating income of $14.5 billion, and then its net sales amount of $280.5 billion. Now, when you calculate that ratio, you get 5.18. This is telling us that Amazon makes around 5% of profit from every dollar of sales. In other words, after paying for direct costs and variable costs, Amazon retains around $5.18 of profit for every $100 of its sales. Now, let's see how this looks for Walmart. Using the same formula of taking operating income over net sales, we see that Walmart's operating income is $20.6 billion, and its net sales for the year is $523.9 billion. When we calculate that ratio, we get an operating margin ratio of 3.93. So this tells us that Walmart retains around $3.93 of profit for every $100 of its sales. When we compare this to Amazon, we can see that Amazon has a higher operating margin. This is because its operating margin hovers around 5%, whereas Walmart has a slightly lower operating margin at around 4%. The key point here is that Amazon has a higher return on sales and is more profitable. Now on this slide, we will calculate the pre-tax profit margin ratio for Amazon. So what is the pre-tax profit margin ratio? This is used to measure the operating efficiency of a company before deducting taxes. The ratio tells us how many cents of profit the business has made for each dollar of sale. This is a useful ratio to compare companies operating in the same sector. The pre-tax profit margin is sometimes preferred over the regular profit margin, since the impact of income taxes can make the comparison of profitability between companies a little bit misleading. In simple terms, though, a higher pre-tax profit margin is a sign of a healthy company with an efficient business model. Now, how is this ratio calculated? This ratio is simply calculated by taking income before taxes and dividing that by its revenues. Here, we notice that Amazon has income before taxes of around $14 billion. Revenues for the year was $280.5 billion. Once you take income before taxes over its revenues, we come up with a pre-tax profit margin ratio of around 4.98, or a little under 5. So this tells us that Amazon makes around 5% of pre-tax profit margin for every dollar of sales. In other words, after taking its revenues and backing out its operating expenses before taxes, Amazon retains $4.98 of profit for every $100 of revenues. Now let's see how this looks for Walmart. First, we'll notice that income before taxes is around $20.1 billion. And then we have revenues of around $523.9 billion, or a little bit under $524 billion. Now, when you calculate that ratio, we get 3.84. So this tells us that Walmart makes around 3.8% of pre-tax profit margin for every dollar of sales. After taking revenues, backing out its operating expenses before taxes, Walmart retains $3.84 of profit for every $100 of its revenues. How does this compare to Amazon? Well, we can see that Amazon's pre-tax profit margin was almost 5%, whereas Walmart is below 4%. So, in other words, Amazon has a healthier pre-tax profit margin than Walmart, or in simple terms, Amazon is just more profitable than Walmart. Hi, welcome back. In this lecture, we will go through part 3 of the profitability ratios, where we will walk through the net profit margin ratio. Now on this slide, let's calculate the net profit margin ratio for Amazon. But first, what is the net profit margin ratio and why is it important to us? The net profit margin ratio, or net margin for short, shows us how much net income is generated as a percentage of revenues. This is helpful because the Welcome back. In this lecture, we will go through part 4 of the profitability ratios, where we will walk through the return on assets ratio. So let's calculate the return on assets ratio for Amazon. But first, what is the return on assets ratio and why is it important to us? Well, the return on assets ratio lets us know how much profit a company is able to generate from its assets. In simple terms, the return on assets measures how efficient the company is in generating earnings from their assets on their balance sheet. As such, the higher the ratio, the more efficient the company is at managing its balance sheet to generate profits. So how do we calculate the return on assets ratio? This is calculated by taking the company's net income and dividing it by its average total assets for the period. Here we can see that Amazon had $11.6 billion of net income. And then we can calculate an average total assets amount of $193.9 billion. The average total assets amount is calculated by taking the period end total assets for both years, so $162.6 billion and $225.2 billion. And we'll take the total of that and divide it by 2, and that gives us $193.9 billion of average total assets. When we take net income over the average total assets for Amazon, we come up with a return on assets ratio of around 5.97. So this tells us that for every $100 of assets that Amazon owns, it was able to generate a profit of around $5.97. In other words, Amazon is able to be efficient with its assets and generate approximately 6% from its assets. Now let's compare this return to Walmart's. First, let's find the net income, which is $14.9 billion. And then we'll calculate the average total assets for Walmart, which is the $236.5 billion from 2020, and then $219.3 billion of total assets from 2019. You take the total of that and you divide it by 2, and we get an average total assets amount for Walmart of $227.9 billion. Now, when you take the net income of Walmart over its average total assets, we come up with a return on assets ratio of 6.53. So what does this mean and how does it compare to Amazon? Well, here we can see that Walmart is able to generate a profit of around 6.5% from its assets. As compared to Amazon's return of assets of 5.97, we can see that Walmart is able to generate slightly a higher return at around 6.53 as a return on its assets. In simple terms, Walmart is actually more efficient than Amazon in terms of its ability to generate income from its existing assets. Welcome back. In this lecture, we will go through part 5 of the profitability ratios, where we will walk through the return on equity ratio. So let's calculate the return on equity ratio for Amazon. But before we get started, let's find out what a return on equity ratio is. To start, the return on equity measures how effectively management is using a company's assets to create profits. One item to highlight is that the ratio is largely dependent on the industry and sectors that a company operates in. As an example, investors can consider a return on equity ratio above 15% to be acceptable, whereas less than 10% would be a poor return on equity return. So how is this calculated? The return on equity ratio is simply calculated by taking the company's net income over its average equity amount. Welcome back. In this lecture, we will go through part 5 of the profitability ratios, where we will walk through the return on equity calculation. So let's calculate the return on equity ratio for Amazon. But before we get started, let's find out what the return on equity ratio is and why is it important to us. To start, the return on equity ratio measures how effectively management is using the company's equity to create profits. One item to highlight is that this ratio is largely dependent on the industry and sectors that a company operates in. For example, an investor may consider a return on equity ratio above 15% to be acceptable, whereas a ratio less than X% would be considered a poor return on equity return. So how is this ratio calculated? The return on equity ratio is calculated by taking the company's net income for the year and dividing that by the average total equity for the company. Here, we can see Amazon generated net income of $11.6 billion. And we can see the average equity amount for the year. First, we'll take $43.5 billion, add that to $62.1 billion of ending equity, take the total of those amounts and divide it by 2, and that gives us an average equity amount for Amazon of $52.8 billion. Now, when we take the net income of $11.6 billion over this average equity amount of $52.8 billion, we get a return on equity ratio of 21.95. So what is this telling us? This gives us an insight that with equity of around $100, Amazon is able to generate a profit of around 22%. This is a very healthy ratio, and this reflects a good return on equity by Amazon. But let's see how this compares to Walmart. For Walmart, we can see its net income of $14.9 billion. And we will calculate its average equity of $72.5 billion plus $74.7 billion. You take the total of that, divide it by 2, and we come up with an average equity amount of $73.6 billion. Now, when we take the net income of $14.9 billion divided by $73.6 billion, multiply that by 100, we get a return on equity ratio of around 20.2. So here we can see that with equity of $100, Walmart is able to generate a profit of around 20.2%. Similar to Amazon, this is a healthy ratio in this industry, which reflects a good return on equity by Walmart. However, we can see that Amazon's return on equity of around 22% is still higher than the 20% return on equity from Walmart. But either way, these returns are good for both companies, with Amazon having a slight edge in this profitability metric. Hi, welcome back. Now we will go through the scorecard for the profitability ratios. First, we calculated the gross margin for Amazon and Walmart. This came up to 40.99 for Amazon and 24.69 for Walmart. So in this case, Amazon was more profitable. Next, we calculated the operating margin ratio. We came up with 5.18 for Amazon and 3.93 for Walmart. So again, in this case, Amazon was more profitable. We then calculated the pre-tax profit margin ratio, which was 4.98 for Amazon and 3.84 for Walmart. And finally, we calculated the net profit margin ratio for Amazon and Walmart, which was 4.13 and 2.84 respectively. So again, the advantage goes to Amazon. Next, we calculated the return on assets ratio for both Amazon and Walmart. This came up to 5.97 for Amazon, but 6.53 for Walmart. So Walmart has a better return on assets. And last, we calculated the return on equity, which came up to 21.95 versus 20.22 for Walmart. So in this case, Amazon had a slight advantage with its return on equity. So overall, to recap this section, we can see that for the most part, Amazon was much more profitable and had stronger profitability metrics as compared to Walmart.